C3.ai announced their earnings last night, and this morning price is gapping down into a level where there were buyers that were established back in May. We had a leg in or rally up, basing candles, and then the rally out, followed by a gap the following day, breaching and closing above the pivot high that was established back in April. Now what's interesting is that, again, this was a level where there were buyers. You can see how price dipped into the upper portion of the zone and reacted. You can see price is now off the lows. In addition, what's interesting is that price is also bouncing off the 200-day moving average. When I go to the monthly chart, you can see price is kind of bouncing off and respecting that 13 simple monthly moving average. Now let's get into the news as to why price gapped. This article is coming from Investor Business Daily. C3.ai, a hot AI stock sinks as investments push back profitability. So the shares fell after the software maker backed off its target to turn profitable on an adjusted basis by the fourth quarter of this fiscal year, amid growing investments in AI. Now, when it came to their gross margins, it came in at 68.6%, below Wall Street estimates of 73.1%. Amid investments again in AI, the company now expects an operating loss of $100 million in fiscal 2024, up from an estimated operating loss of $70 million. Now, while the company continues to drive free cash flow positive for Q4 and for the full year fiscal 2025, the company is now backing off its prior goal of achieving non-GAAP profitability by Q4, said an analyst at JP Morgan. C3.ai expects revenue growth to re-accelerate as more AI pilot projects ramp up production. That's going to be key to their top and bottom line. An analyst at Oppenheimer, Tim Horan, said in his notes to clients, C3.ai is in the right place at the right time as every enterprise evaluates the full few purpose-built platforms to build and deploy AI applications, but the food chain needs time to develop. Speaking of these built platforms, which is what C3.ai does, let's hear it from the horse's mouth. This is the CEO, Tom Siebel, as he discusses their services and demand moving forward.
Joining us now is Tom Siebel, C3.ai Chairman, CEO, and co-founder. Tom, a lot to go through, but let's start on the results. It looks like non-GAAP gross margins came in a little light of expectations. The street was looking for something in the 70s, came in at 69, but about in line with the results and the guide so far. Can you give us some color on the quarter?
A solid quarter, but we exceeded revenue, exceeded cash, exceeded earnings. As it relates to gross margins came down a little bit associated with all the trials that we're doing that are aligned with the consumption-based pricing model that we put into effect. And I think the uptake that we're having with the generative AI applications, which is just huge. And basically the C3 generative AI, the value proposition is we take the customer live, whether it's Missile Defense Agency, an intelligence agency, Koch Industries, whoever it might be, we bring them live on generative AI in 12 weeks for $250,000. And after that, they pay by a consumption model. Well, in the initial applications, the margin on those trials is not high. I mean, we're going to invest whatever it takes to make sure that all those customers are successful.
And what about remaining performance obligations? It looks like it came in at $334.5 million, right around there. The street was looking for $380. How's the pipeline looking? And what sorts of industries are knocking on your door and wanting conversations?
Pipeline is growing substantially. RPO going down is a absolute direct effect of change to consumption-based pricing. So rather than doing enterprise deals of 10, 20, 30, 40, $50 million, we're doing these pilots for $250,000 or $500,000. And so RPO, and then it's just consumption-based pricing from there. So RPO goes down, revenue goes up. That's the way that model works. As it relates to industries, we're seeing massive uptake in defense. That is our most rapidly growing industry, defense and intelligence, with the CDAO, the Department of Defense, United States Air Force, Army, everything involved contested logistics, predictive maintenance, what have you. So defense is a huge business. Manufacturing, supply chain, demand chain, financial services, businesses, in general, the industrial, commercial, and AI interest in enterprise AI has never been higher than it is today. And so the world is kind of coming our way.
So then what's the impact you expect from these domain-specific offerings, these 28 domain-specific offerings that you're announcing today, and how soon?
It's immediate. Okay, so I would say if we look at our pipeline of opportunities that go out the next 12 months, the pipeline for the product that is the longest is substantially generative AI. And people, when we get to industrial applications, they're not deploying generative AI for these kind of cute chat PT, let's chat stuff. And we want to run factories, we want to run supply chains, we want to do predictive maintenance, we want production optimization, we want more productive human capital. So that takes domain-specific applications of these large language models for SAP, for Oracle, for Salesforce, for supply chain, for demand chain, for sales, for marketing, for customer service, for utilities, defense, intelligence. And so we have 28 applications that are available today. They can be ordered today on the Azure Marketplace, the Google Marketplace, and the AWS Marketplace. And this is a huge land grab in generative AI. And John, we are going to market.
Yeah, very exciting, Tom. I am curious about the Baker Hughes relationship, by far the largest contributor to revenue, at least up until this point. How is that progressing?
It's great. In other words, the Baker Hughes relationship is great. We're jointly selling with them all over the world. They are, certainly our most important partner, and we are on speed dial with them. And I don't know how it could be going better. And they're also a large consumer of our technology for internal use. So we're killing it. I don't know how many. I think we've closed over $650 million in business in oil and gas together. So I don't know how that could be going better.
So despite the bump in price off the lows after the gap down, here's my reasons to not buy the stock. Number one, as price came down, it did establish a seller's level. Let me just highlight that in blue. All right, so technically price is range bound between a daily buyer's level and a daily seller's level. So that's going to serve as resistance. Now, if I go to the weekly chart, what we see, what was support is now resistance. So now you have confluence, further solidifying that area as a tough level to get through. If and when price breaches this area, then you got to deal with the multiple weeks of selling pressure at 40, demonstrated by these wicks here. And then if that wasn't enough, the reason why price gapped higher, opened and then went lower and could not get above the previous high at 48. It ran into sellers to the left of price. So is the party over for C3.ai? For now it is. And you can just look at NVIDIA. NVIDIA is off its all-time highs by roughly $50. NVIDIA is the Bitcoin to cryptocurrency as NVIDIA is to AI. So for those reasons, the gap down is not a buying opportunity. You breached the 200-day moving average. Look for your next level to serve as some type of support at $24. Thanks for watching. Subscribe. Please like the video.